Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for months now. It's really excellent. He does excellent short videos on many interesting topics about the global economy, the U.S. economy, investing and finance. He has a very large and rapidly growing YouTube channel that covers many interesting topics about the economy and investing. Over 200,000 YouTube channel subscribers, over 35 million views on his YouTube channel. I think he just told me before we started recording, his channel is a top 15 channel for finance now on YouTube. So congratulations there. Travis, the Economic Ninja, thank you for joining me.
Hey, thank you so much. I have been a fan of yours for, I want to say, greater part of a decade. So I know exactly who you are. I love your work and I thank you so. It's seriously an honor to be on this channel.
I am shocked that you've been listening for a decade. I know George Gammon admitted that he was listening back in 2011 and 2012 when he retired, and he was learning from a lot of my interviews and my analysis back then, Austrian School of Economics. After he retired, he said he had a lot of time and he started learning from a lot of my videos.
Yeah, no, I'll blow your mind. Do you remember Tekoa da Silva?
Yeah, Tekoa. Does he still work for Sprott?
I don't think so. I think he's doing some work with a campaign, let's say. I'm pretty sure that's what his main thing is. I don't know if he's still with Sprott, but he hit me up and he said he was a fan. I'm like, well, yeah, Tekoa, I'm a fan of yours. He goes, what are you talking about? And I'm like, I learned everything about street name recognition from you and how to get shares in my own hands. He's all, no way. I literally go to my office. I take a screenshot of the report that I'd read of his in 2011 and send it to him. And he was floored. And so, yeah, even some other YouTubers, the top, first three YouTubers on YouTube, they were blown away when I met them that I knew exactly what they used to cover and everything. So I've been in the space a long time, but I didn't go public until just about a year and a half ago because one of my companies I sit on the board of literally forbid me from getting on YouTube because they said, we don't want any of your crazy theories about money to hurt us raising money, because I had crazy theories. I tried to get my tech company to buy Ethereum at $1. And so, I was crazy. So anyway.
I think I did a video on Ethereum back in 2016 because I had some connections that that were tech reporters and they were talking about it back then. There wasn't that many altcoins back then. It was $5 or $6. So I bought like 33 of them, but I didn't ride Ethereum all the way up though. But
yeah, I was lucky enough to do that. My first personal Ethereum was $50, and I took full advantage of the 2017 ICO craze. I was in a lot of those right in the beginning. It was an amazing year. But yeah, the crazy theories of trying to get my tech company to buy I just wanted them to buy 1,000 Ethereum at $1, and I said, don't worry, it'll be worth about $3,000 to $4,000 to $5,000 in the near future. And that's why they didn't want me to go on YouTube. So now it's ancient history. They're happy I'm on.
So for my listeners who are not familiar with your channel and your background, could you please talk a little bit about it?
Yeah. So I became an investor in 1998 and started buying tech stocks. I got out of tech stocks in 2000, seeing the frothiness. I was following the Wolf of Wall Street, Jordan in real time, watching all the craziness happen in penny stocks and understood. I was following Peter Schiff too in real time back then. And I got out by the skin of my teeth, I guess is the right way to say it. Hopefully. I'm so bad with sayings. But I got out and I let that thing go crazy and bust. And then I started buying real estate as the interest rates dropped. They plummeted because the Fed was desperately trying to breathe life into the economy. I'd never bought a home, bought my first home in year 2000, around 2000, 2001. And within 6 weeks, had my first rental. And before you knew it, I was buying a house every 8 weeks. And then I got out of real estate in 2005, mid 2005, because I heard Ben Bernanke say, oh, there's no problems with the mortgage-backed securities. We're stemming the tide. I saw the interest rates rising and I was screaming for everyone to sell. And so I liquidated everything I had. I had a pretty large portfolio back then. And then I sat back and I just had a couple of side businesses, side hustles through the Great Recession. And then I got into cryptocurrency and I was in oil. So I've been in a lot of different investments, like actual limited LLPs when it came to oil drilling. Robert Kiyosaki got me into that in 2005. So became accredited when I was 2005 and then never looked back. So yeah, I've got a pretty vast, let's say, portfolio of different types of investments, both winners and I've definitely lost.
Sounds like you're pretty good at reading the cycles there, because nowadays with what the Fed's doing in intervention and wherever the bailout money is going or cheap credit, that's where there's going to be a boom and bust cycle.
Yeah, and I'm glad you brought up the word cycles because that's what my whole channel is about. Because I didn't realize I was interpreting and reading cycles when I saw the .com and then I saw the the MBS implosion. It wasn't until 2010 when I started learning about real money. I started going back farther and farther into history, learning about the crime of, was it 1873, looking at the Great Depression cycles, reading even Shemitah cycles, going into the Bible, 7 and 10 year cycles, bigger cycles like 50 and 100, which were in a 50-year, we're actually, I believe, a 50 and 100-year convergence right now. We can explain that later, but cycles are very important, and there's nothing new under the sun. And what's happening right now in real estate is really exciting to me because there's very few YouTubers out there. I know Jason Hartman was, Robert Kiyosaki. There's a handful of YouTubers that were investing in real estate back before the crash, and literally everything in real time is happening that happened in mid 2005 to 2007 right now before our eyes. And it's exciting to be able to show this to people in real time.
So you think the odds are very high of another real estate market crash in the near future?
So not only is it high, it's 10 times worse, and I'll explain. In 2005, we had the mortgage-backed security crisis. I did a video the other day where Ben Bernanke was so nice to come out and rat out his buddy Jerome Powell, J-Rome, and say, you guys missed it. You didn't get on top of inflation fast enough. Well, just, Ben Bernanke is about to sell a book, and he's got to say something stupid. So he came out and blamed his buddy. But I pulled up a video of 2005 and 2006 interviews with CNBC about them calling him on the mat and saying, hey, we're hearing all kinds of rumors. There's some kind of housing bust. There's problems in the mortgage-backed securities. And he goes like, no, there's no problem. And by the way, I don't see what you see, because real estate can't fall all at the same time around the country. And he was 100% wrong, but he wasn't wrong. He actually knew what he was doing. And that's what people don't realize. So right now, what we have is what's called the CMBS crisis. I did a video last June about it, and it ranked really well up on YouTube Google, because I started talking about a company called Evergrande even before it was in the news. I was talking about the leverage Evergrande had with the CMBS mortgage market, the commercial mortgage-backed securities. And what's very scary is that a large swath of CMBSs around the world are actually negative amortizing loans. And there's an open whistleblower case on CMBSs right now that has been open for approximately 3 years of insane negligence, let's say, on the part of people that are bundling these CMBSs together. And they're already starting to implode. We just saw Blackstone have to give back one of their flagship properties to the bank, and they didn't own it. They had a loan on it at a 50% haircut because they've lost so many tenants. And what people don't realize is you're about to see an epic boom. That the thing in China is already huge. It's massive between Evergrande and all these other developers that are imploding. But I want to remind people that when Lehman Brothers fell, after Bear Stearns, those two large institutions also brought out a lot of other dirty dealings in the mortgage industry. And it took the whole world into a recession, the Great Recession. What is happening in China right now is about to expose a lot of things in Q3 and Q4 in America of not only how exposed pension plans and hedge funds are to Chinese property, but on top of that, you're about to see a massive realization of the write-downs that are happening in America in commercial real estate, because we literally had the great migration from being in your office to being at home. And so a bunch of CFOs are going, I don't need to pay rent anymore. And that is being hidden right now on balance sheets, and it is about to be exposed, and it is going to be fireworks.
The DC metro area has 5 of the largest average median family income counties in the entire country. I think it's 5 out of the top 8. And there are tons, to add to your points, there are tons of empty spaces in shopping malls and strip malls, large shopping malls that are high end, that are medium end, just tons of spaces that are closing. And I'm just wondering, for the last 2 years, I've been looking for this along with you, the commercial real estate problem. So I guess it was delayed. I was expecting this in 2020, 2021, because there's trillions of dollars in commercial real estate loans, these real estate investment trusts, which are pension funds buy these or turn these into real estate investment trusts and buy these commercial properties here in the DC metro area, like these shopping malls or these strip malls, and then they rent them out for cash flow. And these things are empty. They don't have tenants. So I'm wondering, these mortgages, and wasn't there an article in, I think, August 2020. It was by a whistleblower. It was in the Atlantic. The guy was a former investment banker, and he helped design some of these mortgage-backed securities. He was talking about how Wells Fargo had $1 trillion worth of this stuff hidden off balance sheet. So we'll see what happens with that.
Well, here, let's talk about what your comment. I love your remarks. So the reason why you were looking for problems around 2019, 2020 was because we just came out of a Federal Reserve interest rate hike cycle from 2015, I believe it was October, till December of 2018, the Federal Reserve embarked on a rate hike cycle. They started with 25 basis points coming out of the Great Recession, right, and doing all the quantitative easing. And they said, we're going to start raising rates. And they started a dot plot plan. But they had the same dot plot plan back in 2004. And what happened is they started raising rates, and they found that the economy could not handle, by the time they hit 2 and 2.25 Fed funds rate, businesses were starting to contract because they could not service the debt at those interest rates. There was so much money printed and so much loans taken out that companies could not do it. And so what happened is from October of 2018 till December of 2018, it was Christmas Eve, the Dow Jones posted about a 19.5% first leg down in that crash. And what we saw was the president at the time, Trump, was screaming and yelling, saying the Federal Reserve is trying to crash the economy. I actually moved all of my retirement into bonds. That was in October 2015. We saw the 19% correction. And then the Fed went, okay, on Christmas Eve, we're going to stop. Or was the day before? We're going to stop raising rates. And then 30 days later, they made the first rate cut. It was the fastest time in history we saw a Federal Reserve go from a raising cycle to a dovish, like cooling off, right? And stocks rallied. But let's go back one more cycle. In 2004, that is how I knew we were at the top, because we had a perfect storm. We had gasoline prices slowly start to rise. People had that wealth effect from homes exploding in price because of low interest rates. So they're out buying SUVs, gas guzzlers, and they were buying all kinds of stuff. Real estate wasn't going up, but then we started seeing interest rates start to go up. And a 30-year fixed in 2004 for me, when I was buying up rentals, was sitting around, I want to say it was 5.25%. By the time it topped out in 2006, we were sitting at a little over 7%, right? Now I'm talking about for not owner occupied, but what I was doing was rentals. I knew that people could not deal with all of the rising prices, and we were going to start having deflation because people were going to unwind and start liquidating things, right? And so that happens very normally. The Fed can create money or they can take it away. They can also raise rates and lower rates. That's pretty much all they can do. And so now we are seeing that exact thing. But the problem is, and I call it right now, Fed's not going to be able to get over 1. I'd be shocked if they make it to 1.25% Fed funds rate, because there is so much money in the system, it is going to literally implode on itself. So when people say, are you sure, or you're pretty confident that we're going to go into a real estate collapse? If you think about just the amount of everything, like we've never had the everything bubble. We really haven't. And I mean, in 1970, we had high interest rates. But we didn't have really high interest rates until inflation had gotten to a certain point. We've got heavier inflation right now because we all know they're lying. So if people say, are you positive? I'm like, yeah, I'm positive. So that's where I'm coming from.
Well, since 2008, the financial crashes. So deflation, if the Fed raises interest rates, reduces its balance sheet, tries to cut the money supply, and that results in lower asset prices or falling consumer prices as a effect of deflation. The deflation has lasted, it's painful, but it has lasted for shorter and shorter time periods. The reason it's so painful, though, is how much currency and credit is sloshing around. So you have record amounts of hedge funds, family offices, portfolio managers, and investment banks harassing me on Twitter. You have retail investors trading on their smartphones, cryptocurrency on stock margin, or stock options on stock margin trading on their phones. So the more margin, the more credit in, when the asset prices fall, the selling feeds on itself. You have a liquidation phase, you have margin calls. But to my time period, though, from 2008, in 2008, we had low asset prices for maybe 6 to 8 months for low stock prices before the Fed changed the rules, changed mark-to-market accounting for the large U.S. banks, implemented the QE program. This puts a strain on U.S. federal government tax revenues, though. So if real estate prices do stay low, Travis, we're looking at potentially like the states becoming insolvent then and bankrupt, because then their property tax revenue and all their sales taxes that they charge for people shopping and eating out, all their tax revenues collapse then too.
Well, yeah, but if you think about it, so you're saying your idea is that states are going to collapse because they can't, because real estate's staying low, and so their taxes are low, correct?
Their property taxes would collapse. There would be an enormous hole in their government budget funding because most states don't run surpluses. So then they would have to go to the Fed for a bailout. And I don't know if they're going to announce that publicly or not, but then the Fed has to actually, one of the main reasons for quantitative easing, not only is it to inflate asset prices, it's also to fund and subsidize government. So,
you're right. So let's go back into the past real quick and let's use property tax as an example, and we'll go back to the Great Recession. The one thing about property tax is it can change, and it's supposed to change, but governments are very slow to change it. And I'll give an example. And when I bought my last home in 2005, I told my wife we were liquidating a portfolio of 14 properties at that point, and I said, we're going to buy a house. We are literally buying at the top, but it's okay. We're going to sit back during this crash. We paid, I want to say it was $500,000 for that house. That property actually went down 40%. And it took about 2.5 years for it to get down that low. In that amount of time, every year I'd get my tax bill. It would go down barely a little bit. They were not keeping up with the rate of drop. So my county still got pretty much close to the entire value of that house for those next 2 or 3 years. It wasn't until they were sued by a group of people that said, hey, you're not paying attention to the property market. And they went, oh, sorry. Okay, fine. You literally had to go to court and now we'll fix it. And they paid back a couple people, but really they got their own. So what I tell people is when they think that, it's a very slow grind. And you probably know government employees. I'm one too. We're slow. And it's funny because that's why booms and busts happen. Because when the smart people are exiting like myself, the masses are still in. And so it's the same way with these government employees, the bureaucracy, the red tape to get these things changed. They're still going to, after a market collapse, they're still bringing in a ton of revenue with taxes, because even if somebody walks in their house, someone's going to pick up that tax lien, or they're going to, the banks are going to pay for it, and they're not going to question. Does that make sense to you?
Well, in 2008, you had the U.S. Treasury tax revenues. They collapsed by 30% in under 6 months. And in 2020, they collapsed too. But I think that was also from the real economy. So it was a combination. It was a combination of asset prices falling. So stocks, bonds, real estate, those values fell. And then also the normal type of sales taxes that the consumer gets that state and local governments normally charge. And then there's the federal sales tax too on some of the items there.
Income tax. Income tax is the biggest. Yeah. Yes. So let's talk about income tax, because the federal government just brought in a record year. You know, if you think about it, that wealth effect was pretty impressive. So they're bringing in record amounts. And yes, they can crash. But the sad thing is, I'm sure you know this, Jason, they could change the rules at any moment, right?
Yep, and that's part of Stagflation tax law.
Yeah, so this is one rule that I've been talking about. I put out a video, so it was recorded, and I said, I believe that this is going to happen. If the Federal Reserve has to stop, I believe they're about to do an about face. We're going to see about 2 more weeks of extreme pain in the markets. And then they're going to turn around and say, you know what we're going to do is we're just going to hold off on raising rates. And that's going to cause a euphoria in markets, multiple markets. Stocks, gold, silver, things like that. Crypto will probably be take advantage, but it's going to be short-lived. One thing they're going to do to hold this up is I believe they're about to change the 30-year conventional mortgage into a 40-year. Now, the last time this happened was in the 70s. I believe it was when we went from a 20-year to a 30-year. And not a lot of people talk about that. And I said, you know, if they try and pump this up and they do that, the scary thing is, even if you believe you're at the top of the real estate market, which I do believe, if they do that, you're going to be forced to dive in and use debt to buy real estate with 40-year mortgages, because once people figured out that I can literally extend my loan term out 33%, which is to me slavery, right? Debt slavery. But I can lower that payment. The greedy people, which is most of the herd, are going to dive into the next nicer house. And it is going to be 2001 to 2004 on cocaine. And so that's the one thing when we talk about changing rules, I think that's the next one on the chopping block, is they're going to chop the 30-year mortgage. They're going to turn into a 40.
So you think then that we will have deflation in the near future, but it will not last for a long period of time?
Yeah. So the thing with boom and bust cycles is the length of time. Giving the example, and I don't have my information in front of me. We're just, rattling off, figures. The Great Depression, when it bust, it took like 14 years, I believe, to get the numbers back. If my memory serves me right, in 2000, it blows me away. In 2001 and in 2008, we saw the stock market, the Dow Jones, lose 50% of its value, right? But it took about what I think 5 years or 6 years to recover in 2001. It took about 6 years, maybe 7 years, if my memory serves me, on a point basis to recover, right? Well, what's happening is every time these boom and bust cycles happen, the buildup is stronger, the bust is shorter but more extreme, right?
Yes.
And so what we're seeing right now is I'm already seeing deflation in real time. Deflation to me is the decision that someone, a consumer goes, I used to buy this every day or every week and use it. Now I don't have the money, so I am going to stop buying it. Like, I'll give you an example, Netflix, right? We could talk about going woke, and that's the reason, but a lot of people are cutting the fat out of their monthly budget. So they turn around and they're now not paying that Netflix subscription. Well, now the stock goes down, which means there is somebody that had a wealth effect that is now not going to go to dinner every night because his portfolio is going down. There's also employees that are being lost. We're seeing it in the mortgage industry with better.com. People are getting laid off left and right. So every time someone gets laid off or someone decides not to spend something, that is deflation in real time. What most people think is deflation is the day that all of a sudden the switch is flipped and you see Aaron Burnett crying on CNBC going, oh my gosh, the stock market's down 7%. And, this is the end of the world. That's not deflation. Deflation happens in the beginning, like right now. Airlines, air travel is down 16 or 17% month over month. That is real deflation. When you see the trucking industry collapsing 26%, fewer loads are being moved as in May as opposed to April, that's deflation. We're literally witnessing it right now. And so deflation starts in subscription services, it moves to travel leisure, then it moves to discretionary spending, and then it moves into real estate and the bigger ticket items. And I believe that this is going to happen so fast. By August or September, we're going to have full-blown chaos, collapse.
I think there's so many distortions caused by bad central bank policy, bad government policy, bad policy by regulators. I do not think we're going to see a lot of deflation in food and energy. I think what restaurants and grocery stores have been doing instead is shrinkflation, where the portion size of the food decreases drastically. The sticker price of the item either stays the same or goes up a little bit. The consumer is fooled. So we're seeing a lot of stagflation and shrinkflation. I do not see deflation, at least not yet, in food and energy, because there are legitimate problems with because there are legitimate problems with the supply chain, normally because of policy from governments and regulators, but also lack of supply side investment on a lot of these key commodities.
So I completely and utterly agree with you. And you notice I didn't say food and energy in that description of deflation. And the reason why is as these boom and bust cycles spread out, they actually get closer in time, because I talk about 7 and 10 year economic cycles, but now I also talk about 50 and 100. And right now, we have not seen in the last 50 years the stock market and the bond market correcting at the same time. So that's a pretty big sign. But also what happens is when the crash gets big, these 50 and 100 year cycles, when they get big, people race to what they need and necessities. And what's scary, and I mean this very seriously, what is scary about this time is in the last 100 years, we have not seen not only inflation, but supply chain crisis and wars and rumors of wars. That is, and let's add the big one in the room, because I started covering the dollar losing its reserve status the day that Saudi Arabia walked and went with Russia, literally 50 years to the week, right? What's crazy is we've all of a sudden seen all this perfect storm converging, and it's on top of a currency cycle. So this is the big one that's coming. So I agree. You're not going to see deflation. I believe transitory hyperinflation is the word to use for this fall. And yet it will be in energy, that will be in food, and it will be food wars. I mean, I've told my subscribers I'm long sugar right now because the amount of energy it takes to produce sugar. So you have a double whammy. You have food, sugar, which is needed in everything just about these days. It's sad, but it's true. And you've got energy costs on top of that. So that I completely agree with you.
And it seems like every couple weeks or month now, we have a new country that's announcing either a fertilizer export ban or a wheat export ban. So there's less global trade, there's less free trade, and there's more protection. And there's more nationalism, more protectionism, because these politicians and bureaucrats in these countries, they want to make sure their domestic population is fed first. So there's not like a Sri Lanka. I know you've done videos on Kazakhstan, the food riots and energy crisis with the electricity prices have doubled in Kazakhstan, and in the food riots in Sri Lanka, because in these poor countries, if the food price on a basic staple crop goes up 20, 30, 40, 50%, if you're poor, that's the difference between life and death and no food on the table.
I agree. And you know, the greatest example of this was the Arab Spring. History has shown us that when food prices reach about 40% of the average home's income, that is when they start to take to the streets. And you've literally been warned. The El Presidente, Jeff Morgan, came out and said, hey, there's food shortages and they're coming. Now he's got his blame, but they also don't want to talk about all the food producing companies that have burnt to the ground in our country since November. Yeah, that's interesting. And so we are seeing something that is so epically historic. And what I want to focus on is the positive, because when you know something bad's coming, a smart, wise, and prudent person does something to avoid it. It's a moron or a fool that runs headlong into the trouble. Right. And they just, they don't listen to anybody. They roll their eyes. Cool. We got a lot of those people. They're called sheep. The cool thing is there's about 3% of this world that are the elite. There's 1% that are truly the elite. There's 2% of the world of people that know something's wrong and they want to do something, but they don't really believe in themselves. And what I'm trying to do is find those 2% of people and say, hey guys, if you prepare now, get out of debt, you think ahead, you hedge yourself with inflation hedges. I know it sounds weird with gold, not doing its job yet, but it did the same thing in the mid to late 70s. Get ready. If you prepare like that, when this thing crashes, even if your portfolio goes down, you have a little bit, you have something, you have more than the guy next to you. So you're going to go and buy his house.
Well, are you in the camp that paper gold and silver prices in US dollars are manipulated? Because the gold and silver prices in pretty much every other currency, they're doing very well, except for the US dollar gold and silver price.
Paper gold and silver is total crap, 100%. And I'm going to tell you what's happening. And I completely love that we have paper gold and silver because I pick up physical at an amazing discount. But this is what is really scary too. Before Lehman Brothers collapsed, we saw the stock market start to trend lower. As Bear Stearns closed their doors in the spring of 2008, remember, we'd all been given stimulus checks in 2007. That's how bad it was. People don't remember that. By spring of 2008, Bear Stearns went down. I'm freaking out. The stock market started to trend lower. Countrywide stories, scandals were coming out and all that stuff about MBS. And gold and silver started to sell off. And what people don't realize is that these hedge funds and very wealthy people, they like liquidity. And one of the liquidities they do is their exposure to gold. They use paper. And so what happens when things start to go down? They're starting to get margin called. We're seeing this right now. They liquidate their winners, right? They liquidate things that they feel are safe. It's their insurance. So they start to liquidate their paper, gold, and silver. That starts to sell off. And then you see the miners get hit really hard. You see precious metals get hit hard. But something that's happened right now that has not happened in the last 50 years is what you and I are on right now. These applications on the internet. There's so much information being exchanged. And when Wall Street Silver came out, I became friends with the guys that started that. When my YouTube channel started, this real sharing of information that hasn't happened even since you've been on YouTube about what's going on with the Fed, the reality of real money versus fake money. People started buying up metals. And I actually had Rick Rule on my channel, and he admitted on my channel, on my interview, that he was wrong when he said that these kids are going to get slaughtered by the COMEX because they're just going to change the rules. And Rick said, he goes, I watched them drain the Ottawa vault. And he goes, and I used to say, you're going to get destroyed. You're going to be like the Bunker, the brothers. And he goes, I was wrong. Those guys were three guys with leverage. This is like 1 million kids with cash. He watched the vaults get drained. And I have friends that are brokers. For the first time ever, we saw COMEX bars, silver COMEX bars, hitting online retailers because they're having such a hard time getting physical. People are grasping at these. So they're just taking delivery of their contracts. And we're literally seeing, for the first time in history, the COMEX being drained. And I got to be honest with you, I'm nothing but grins from ear to ear. And the sad thing is, every time the silver price or gold price gets smashed down a little bit, it doesn't matter because the premiums are exploding. And it's not because they're trying to take advantage of you. Go on Amex right now and say, hey, I want to sell you my Silver Eagle. They're going to offer you like $6 or $7 over spot. That shows you how tight the market is because they can't get it. So this is an exciting time.
If they keep smashing the paper prices and the costs for these miners are going ballistic, they're up over 30% in the last 2 years because of higher electricity costs, higher diesel costs, higher materials costs to build a mine. The cost to build a mine is up insanely high. This is going to also prevent new supply from coming online. So mines that maybe would have gotten to the finish line 4, 5, 6 months ago with gold prices around 2,000 with lower diesel costs, Now those companies are going to have to reissue feasibility studies. They're going to have to figure out the new higher cost structure, the cost of capital. They might not be able to raise the capital to build the mine. So this is going to actually exacerbate the supply problems, especially for silver, because a lot of the silver miners now, I just put out an article for patrons, the silver miners now, some of them, they don't have a profit margin.
Okay, so let's talk about that. I love that. And so I was really blessed to have dinner with Keith Neumeyer from First Majestic a few weeks ago. We actually were talking about this. There was a couple exploration companies with us as well. And I can't divulge who they are because of what they were talking about at dinner. But one of the things that was very important was we were talking about mining cycles. And we saw a massive mining cycle when the last silver boom happened in 2010, right? When silver took off and started that multi-year from November 2008 to we topped around 2010, 2011. Mining also picked up. But what really happened in mining was the exploration companies. And they started buying up properties that some of them were going to market. They were actually starting to produce. And they were over leveraged. Well, when that crash happened, and it was a multi-year crash, the miners took the hit bad. They were going bankrupt. Well, what was happening behind the scenes is large mines were coming in and buying up properties for pennies on the dollar. And that's the most important thing to realize right now. When you're investing in mining operations, you want to find out when they bought that, what they paid for it, and what they really have into that project. And there's a lot of amazing properties right now with tons of gold and silver, precious metals in them right now that these big boys are holding on to. And they're like, we don't need to touch them right now. This isn't the time. That's how you find the gems. But the problem with those gems is it could take years to get those things to production. So there are mining companies that their mining costs are super low, even with this high diesel price, right? But the problem is you really have to do a lot of due diligence to find the good ones.
Or you could just buy royalty and streaming companies like Franco-Nevada, Wheaton Precious Metals, Sandstorm Gold, those types. And then you have a diversified portfolio of cash flows of royalties and streams. And you don't have to worry about the mining costs for a lot of these different companies. As long as the mine stays online, it's throwing off a little bit of cash flow each one. So it's like owning a mining stock ETF.
So you are 100% right. And I was about to interrupt you and you said it right there. As long as the mines keep running. And that's what another thing. So first off, you're 100% right. Royalty companies are an awesome way to go. But you also have to look at the management of the royalty companies and see them at the projects they're in. Now, the more diversified a royalty company is, let's say you have one or two losers, a company that just can't pull it off. They had a great vision, great dream, and they just couldn't pull it off. Well, if your royalty company is well diversified with, let's say, 100 projects or even 50 projects, they could take the hit from a few, right? So I reiterate what you're saying. I think that's a great play.
And this is why diversification is important, because like a lot of people know, we talked about potentially short amount of asset prices falling, stock market crash, or worse in the short term. We'll see what happens depending upon a lot of it depends on what the Fed decides to do and what they say with their press releases and forward guidance. But it's dangerous in this environment, Travis, to be all in on anything. I saw tons of posts and trolls, like people that were all in on Bitcoin or all in on stock options on some of the technology stocks. It is a very dangerous environment to be in like that. And those people have not been through any bear markets.
I completely agree with you. And what is also incredible is, let's say financial YouTube right now, 90% of the people on YouTube that have made it, they have never been investing. They were never invested before the Great Recession. They know nothing but prosperity. And that is very dangerous. I want to warn people, stay with the big boys that have been around a long time. And let me put it this way. You're watching people like Meet Kevin and Graham Stephan, millennials that have made tons of money, tens of millions of dollars. They are now figuring it out where they're going, oh my gosh, we're at the top of the market. We got to start selling our real estate. That's super exciting to me because I was in their position in 2005. So I had to sit there and grin and go, yes, there are people getting it. But with that being said, I say that as a compliment to you, Jason, because I have followed you for so long and you have got great insight, great logic. And like you said, diversification is the key and keeping your peace. Diversification keeps you sleeping well at night. And if you're invested in 5 different bags because of fundamentals, well, then one doesn't do well, but another one blows up. You simply take the profits from that one, dive it into the other one because you still have the fundamentals.
And this is why I study financial history, because you go back and you look through different cycles. You go back and look at bull market behavior, bear market behavior. And yes, history doesn't repeat exactly, but it does rhyme. And there are a lot of similarities. So when I see all these social media posts and all these trolls about how like every dip in Bitcoin is being bought. Bitcoin won't crash. I was seeing just nonstop comments about this for months over the last 6 to 8 months. And I was just worried about that because I was just seeing people saying, I sold all my physical gold. I sold all my physical silver. I'll never buy metals again. I'll never buy royalty and streaming companies again. I went all in on crypto. That to me is red flags because it's a gambler's mentality. You're not diversified. It's like going to the casino and putting all of your savings into a slot machine or betting it all on one number and color on a roulette table.
Well, I'll tell you what, I just had a board meeting with one of my companies, and we have a pretty substantial crypto holding, and it's taken a heck of a hit, right? Still in the green because we've been invested for a long time. We're not selling any, but we do believe that we are going to see next cycle down in Bitcoin around 18, 19,000 bucks. Now, that's not financial advice. I'm not selling. What am I doing? If that happens, I am buying more, but I'm also divested in real estate and other things. So what I'm doing is I'm holding cash looking for deals. So I told my subscribers to move into, not sell anything to a cash position, but stop putting money into investments back in November and start to build up your cash portion and start looking for deals. And like when we're talking about miners, I bought one exploration company. It's down 45%. I know the fundamentals of it. I love it. I doubled my position because I had a larger cash position. So I'm buying on the way down because I'm a value investor, not a speculator. Speculators buy on the way up and they get destroyed. Value investors buy things of real worth off fundamentals. And as it goes down, you buy a little bit more, not a lot. And then you get ready for that upswing and sell it to the idiots on the way up.
And we were talking about this before we started recording about Bitcoin. I've been covering Bitcoin since 2011. I knew Trace Meyer before he even bought his first Bitcoin when he wrote the book, The Great Credit Contraction in 2009, when he wrote an ebook and he was covering gold and silver and he had his Get Your Second Passport websites, How to Vanish, and some of his other websites, Run to Gold, How to Vanish. And then he was trying to explain to me about Bitcoin. And I was interviewing him. So Bitcoin has gone through boom and bust cycles that are volatile and painful every 3 or 4 years since it was first created, since it hit $1,000 for the first time in 2013 and then crashed down to 100. And then 3 or 4 years later, Travis, and you said you got in then, Bitcoin then, it was down for a long time, but then it ran up to 19,000 in January 2017. I was at a cryptocurrency conference, right? As Bitcoin was peaking then in 2017, and then it crashed for years. And then it was in a bear market for another couple of years. And then you had the big boom again.
Yeah, and I sold my house in July of 2018. I bought Bitcoin at $3,600 in like an 8-week period. It went from 36 to 7, I think, $7,000, and that's when I sold my house. And I just rode that wave. And people laugh to this day. They go, I can't believe you sold your house. You missed 30%. I'm like, well, I bought Bitcoin. And they go, yeah, you're even more dumb for that. Like, all right, cool. And I don't even talk to them. And I only say idiots to insult them because, like, come on, we got to call a spade at this point. Because
I think the idiot is someone who wasn't diversified and put like all of his kids' college savings into one cryptocurrency. So I've heard stories about that going around the last 6 months or so, where people are bragging about how like they were doing so well, but that's gambling. You're not diversified.
Well, you know what's crazy? I bought one crypto, and I did this publicly, and I really wish I wouldn't have. But I was at a different level. I had a pretty good amount of a crypto, and I'd made a 18x return on it. And I decided to sell it for another crypto. And 90 days later, that crypto did another 15x. Whereas the one I bought only did a 3. And it's funny because people are like, oh my gosh, I can't believe, I lost $1 million. I could have made an extra $6.5 million off that deal, right? And it was hard. It was hard to deal with, but I took a win. I'd made, whatever, it was 15, 18 times my money. I bought it at 5 cents, sold it at 95 cents. And I took that win and I put it into something else. And it only went up 2 or 3 times. And I dealt with that. And but it's funny, the people that mock and laugh, they'll even mock when you make it and then you could have made it more. So to all the trolls out there, honestly, what's even scarier, there's more trolls now because a lot of them are fake. They're computer generated. So you want to talk about a crazy world we're in, where we're talking about a possible crash. Emotion is what causes a boom or a bust. That's it. Human emotion. And to say that people are amped up now more than they were during the Lehman Brothers is an understatement.
Last question before I let you go, since we have around a 40-minute time limit here for the interview, because we were talking a lot before the interview. We're going to have you back on, Travis. I think you and I get along a lot.
Oh, dude, you're awesome. Like, to even say that, I just heard you say that, you have no idea how much that means. Like, seriously, you're awesome.
Yeah, I feel like, I don't know if you drink. I feel like we can have a couple of beers and just relax and chill and talk for a while.
Jason, I might be drinking right now.
I'm not. I'm sober. I'm gonna get comments like below the video now accusing me of damaging my liver because I started drinking because I started having a beer.
Oh man, yeah, you're gonna get comments no matter what you do, dude.
Well, last question here.
Yeah.
So I look at long-term supply side problems for copper, for industrial metals, for food, energy, fertilizer, uranium. If we do have deflation, if we do have these mining companies, stocks crash, do you think that this is going to make this worse long-term? And do you think that the investing opportunities for some of these commodities industries, if people have cash, if people are smart about it, accumulate on dips, don't try to buy all their positions at once, do you think that they're going to do do you think that they're going to do really, really well with a commodities bull market long-term? Or do you think that deflation will and higher prices will stop consumer demand for some of these commodities long-term?
So when you say the word deflation commodities, the first thing I think of is the day that oil went negative. And I was actually sitting in my real estate office, and I bought out of the money call options on some oil ETFs, literally when it was at like negative $27. And that was amazing. I also that day went and bought out of the money call options on First Majestic. I made like 2,400% on that one. To say that there's about to be opportunity is the understatement of the century. But here's the problem. These swings, like if you would have asked any oil trader just a year prior, even a half a year prior, do you think that oil can go negative? They'd laugh you out of their office. They'd say you're nuts. You're about to see things that will make your mouth drop. And it's going to be very, very scary because we're dealing literally with a humanitarian crisis because we're about to see people starve. And that is going to cause people to freak out. And so what I tell people, there are going to be amazing opportunities, but the number one thing you have to do right now is have debt paid down or off. You need to have some emergency food. And I'm not joking, like 6 months to a year now. And if you got to go on a fasting diet so you can just, enjoy a couple cans of good food and literally watch a purchase of a canned item of food in America will outperform the stock market over the next 2 years. Watch what I say. It'll really happen because food's going to go up as stocks go down. You have to maintain peace in your mind because when you buy something on the downside, because this is a falling knife, and then it keeps going down more, if you bought it on fundamentals, like I believe in this, and you buy a little bit more, you don't know when you're going to catch that bottom. But on the flip side, as long as you're buying things that humanity needs, like you said, copper, there's uranium, there's all kinds of food out there. As this deleveraging happens, and you have to be careful, people are too involved with ETFs. I tell them all the time, it is a derivative game. ETFs are dangerous in my book. And I think that is going to be the next downfall is the ETF market. They're all just held up by insurance policies, essentially. But there are amazing opportunities as long as you know how to properly buy them.
There was actually warnings, to your points there. There was actually warnings from some of these larger exchanges. It was one of the London exchanges and a New York exchange about some of these commodities ETFs that may fail in the next 6 months. So there's been warnings coming out for months now. They issued press releases warning investors in advance that if there's too much volatility in some of these commodities up and down quickly, that some of these leveraged commodities ETFs could default. There could be problems with them.
Well, let me end on this. 6 months, I'm glad you said that because 6 months before the dot-com boom or bust, not Ben Bernanke, but Alan Greenspan came out and talked about irrational exuberance. We saw Ben Bernanke came out with a warning about 6 months before. They're not telling you they think it could fail. They're telling you it's failing, and it will be in 6 months. Well, and I'm telling you, that's the truth. They're actually telling you what they're doing.
Well, look at the rules changes on the London Metals Exchange, and it's actually owned. It's owned. Most people aren't aware of this. It's actually owned by a subsidiary of the Chinese government that's listed in Hong Kong.
Well, it doesn't matter because they're closing their doors, which is awesome.
Well, but you had hedge funds, Chinese hedge funds, and Chinese banks that were short. Nickel. That were short. Nickel.
I love it.
On the London.
I enjoyed every minute.
Yeah, so they were short. So the retail investor who was trying to take advantage of this short squeeze didn't get any of the upside. Nope. Whereas some of the other funds, the managed money, the hedge funds, the professional investors, they were. So the rules were changed. Unfortunately, this is part of Stagflation tax lie. I don't know if you listened to my interview with Cuppy, hedge fund manager Cuppy, that I did a couple of weeks ago. He's predicting over the next, I think, under 2 years that the oil price goes above $200 a barrel and stays there, maybe 250, I think he even said, or 300 potentially.
I called a little while ago when I first started the channel, $350 on the next upcycle. And that's because of some really amazing minds talking about it. But we're talking like a big cycle. We're talking like another 3-4 years. But yeah, I agree. It's going to be a lot higher than it is now. They want to force you into electricity and all that stuff. It's the green initiative.
Well, if that does happen, though, I mean, the average person, their discretionary budget, unless they're growing their income rapidly, they're trying to beat stagflate tax lie, they're doing side hustles, they're entrepreneurial, they're developing multiple streams of income. That extra cost for food and energy, and food production is tied to energy. That's going to take away most of their income and their discretionary budget if they're paying out high prices for gasoline and food.
And that's why by 2030, you'll own nothing and you'll like it. And honestly, they've got a plan for that. And it's called, buses and taxis. And it's scary. But if you're ready for it, you'll come out of this richer than you've ever been.
So, Travis, I really enjoyed our time together. I could probably speak to you. We already spoke for an hour before we started recording. I could probably speak to you for another hour and not get bored.
Thanks, man.
If my listeners want to follow your work, The Economic Ninja, how do they do so?
Really, you just an easy Google search. I'm all over the place now. I've put myself all over, but The Economic Ninja is the YouTube channel, and I'm going to be sharing this on my channel. So I can't wait to see my amazing subscribers jump over and start learning from you, man.
Excellent. Well, thank you very much for your time, and let's do this again soon. I really enjoyed it.
Right on, man. Have a great night.